Hi, welcome to Retiring Well, folks. We got a great show lined up for you today. There's financial jargon out there, and one particularly called alpha. We're going to talk about what that is. As the world turns, we're much more internationally connected than we like to think we are, and I'm going to talk about that. The power of indexing. These are sometimes index strategies that are within insurance products. I'm going to talk to you about what those are. Exchange traded funds, or what we call ETFs. What are they? And then finally, how is Social Security calculated? We're going to be talking about that, so stay tuned.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Hi, in this segment I want to talk to you about alpha. Now folks, this is just more financial jargon that in our industry that we use, but it's something that we look for in a portfolio. Now alpha is simply this. It's basically it's usually represented in a single number. Okay, and it's representing what a portfolio has done compared to a benchmark, or what maybe a mutual fund has done compared to a benchmark. So for example, let's say that I've got a large cap mutual fund. Now folks, that's just a mutual fund that's holding large company stocks. Now probably the best benchmark to compare that portfolio with would be the S&P 500. Being the S&P 500 is the largest 500 companies in the US. So I'm going to look at that large cap fund or portfolio and compare it with the benchmark, which is the S&P 500. Now, if alpha equals 0, that means that portfolio, that mutual fund, was perfectly matched or performed with the benchmark. So, this one did 7% and this one did 7%. That would give that one an alpha of 0. Now, an alpha of 3, for example, meant that portfolio did 3% better than its benchmark. Okay? Now, if that number was represented as a negative, okay, let's say -5 was the alpha. That means that portfolio, that mutual fund, did 5% less than the benchmark that it was being compared to. So can you see how important this is to know? You'll hear a lot of these companies, portfolios, and mutual funds out there trying to say they're trying to achieve alpha, right? What they're basically saying is they're trying to do better than what its corresponding benchmark is. So knowing what that alpha is in a portfolio is very, very important. Now, I've talked before on what is another financial jargon or name called beta. Now, beta is just simply how volatile an account is. All right, so a beta of, like, let's say 0.8 means that it's 20% less volatile than the portfolio it's being compared to. Okay, or to that benchmark, I should say. A beta that's over 1, means it's more volatile than the benchmark that it's being, compared to. So knowing alpha, knowing beta, these are very, very important things that you're going to want to know when you're looking at a portfolio. We have the tools to get behind a lot of these portfolios, these mutual funds, and actually telling you what those two things are. If that's important for you to know, then I encourage you to give us a call and we can tell you what those are.
We look forward to helping you plan to retire well.
Have you ever seen that soap opera called As the World Turns? Well, folks, as it comes to our markets are very much connected with the rest of the world. We are much more globally connected than we realize. Now, I challenge you to take any browser, your web browser, and go to that financial section where you can see what the S&P 500 is doing, and they show you that chart. And I want you to compare it with another ticker called the VEU. That's Victor Edward Uncle, okay? Now basically that's all the rest of the world except us. Now I want you to compare those two things, and I think you're going to find, no matter how far back you go, that if you watch that chart, our markets are pretty much going in tandem with the rest of the world. Again, much more globally connected than we like to believe. So how is that the case? Well, first of all, you have to understand that 40% of our S&P 500, which is just the largest 500 companies in the United States, 40% of their revenue is tied to overseas sales. So that's why we're so connected. I challenge you, if you travel outside the United States, to go into any major city, look around, look down any street, and you're going to find a number of American franchises. You're going to see McDonald's, KFC, you're going to see Coca-Cola sold, all right? I know as a fact that Apple, 20% of their sales are in China alone. So you have to understand, if so much of our revenue is being generated overseas, if they're having an economic slowdown, how long is it going to be before it eventually hits our shores? Okay? Now, most of us always want to look in our own backyard. You know, we might have a good job, maybe it's a well-paying job. We're feeling very secure about where we're at in this economy, and we look around, we look at our own town that we're in, our city. Maybe we see a lot of construction happening. You know, we just see the economy doing very, very well in our own community and our own pockets, and we tend to believe that everybody else is doing the same. That's just an emotional attachment that we might have, or a belief we have because we're doing so well. But folks, again, I say that's not usually always the case. You know, if they're struggling overseas, you know, how much longer is it going to be before it finally reaches our shores? Right? Now, we have the ability to get behind any portfolio and show you just exactly how much foreign exposure you have. If you have concerns about how they're doing foreign-wise, then you're going to want low exposure to that. Well, we can show you that. So if you're somebody that wants that information, really wants to see how you're set up, then please give us a call.
What Larry talked about there is so true. I mean, with the financial jargon that we get into so often in this industry, and there's a lot of terminology and a lot of different things to understand, but that's where, again, that's part of our job, is to analyze those different areas. But one of the things that I think of that simple way you could be looking at your portfolio to better understand sort of how you're structured is looking at if it's maybe that pie chart and trying to see what percentage of the portfolio might be more your fixed income or bonds types of holdings, cash equivalents type of more conservatively structured holdings typically, versus then your equity exposure, whether that's U.S. or maybe international equity exposure, and then it even breaks it down further into large companies, mid companies, small companies. So there's obviously a wide variety, but it's important to sort of look at that to maybe get a general idea of sort of how that portfolio might be structured.
Absolutely, John. You know, I've always said our job as advisors is to educate you of what's going on in our clients so they feel comfortable. You know, these are two big areas, you know, that I think folks commonly don't understand or get frustrated because it's confusing jargon when that comes along. Here at Centennial Wealth Advisory, we have the tools to analyze and get behind the scenes. If you're not already one of our clients, you know, maybe wouldn't you like to know what these things look like? What is the alpha? What is the beta? All of these various things, standard deviation. Then getting into what is your international exposure? How much? Where is that located? You know, like Larry talked about, there's so many factors and globalization, all this happening. You know, how is that playing a role of your retirement portfolio? So give us a call at the number on the screen. We'd love to sit down with you, walk through these things and many more to help you plan to retire well.
Your grandchildren are precious to you. They are your life. This is your time to have that special relationship. Taking care of yourself is taking care of them. Centennial Wealth Advisory is offering a free, no-obligation retirement review to make sure you don't run out of money during your retirement. Centennial Wealth Advisory. Your best is yet to come.
I want to talk to you about what's called the power of indexing. Now, folks, there's a lot of these insurance products out there that will have these indexing strategies, and I think it's important to just kind of understand how they work. First of all, on this axis here, I have $90,000, $100,000, $110,000, $120,000, $130,000. And then along this axis, I've got 5 years, 1, 2, 3, 4, and 5 years. Now, in each and every one of those years, the stock market, I'll pick, let's say the S&P 500 index, is going to make 10% in year 1. It's going to make 20% in year 2. It's going to lose 25% in year 3. It's going to make 5% in year 4. And then it's going to make 20% in year 5. So just one down year. Now, if you look at that, if you average it out in that 5-year period, S&P 500 basically averaged about 6%. Now, I'm going to take an investment that starts off at $100,000 right here in this white line. And in the first year, it's going to be tied to the S&P 500 totally. So that investment went up 10%, so it went from 100 to 110,000. And the next year it grew 20%, so it from 110 went up to 132,000. But then had a 25% loss, so it went from 132 down to 99,000. Now at this point, after 3 years, they're just down 1,000, right? In the fourth year, it makes 5%, so they get up to 104,000. And then in the fifth year, it makes 20%, so they get all the way up to 125,000. Now, if you look at the average for that investment, 25,000 over 5 years, basically it averaged 5%. And it didn't average what this one did, the S&P did in that time, because it had that one down year, right? Now, take an index account. Okay, this is one that says you're going to give you, none of the down. So if the S&P 500 is down, you make 0. But if the S&P 500 is up, they're going to give you 50% of the up. Again, 50% of the up in the S&P 500, none of the down. So what happens? That same investment of $100,000 in the first year made half of this 10%, so it went up to basically $105,000. Okay. In the second year, it made 20%, so it went up to $115,000. But in the third year, because the market was down, it made 0, so it stayed at $115,000. All right. In the fourth year, it makes 5%, so it goes up to $118,000. And then in the fifth year, it makes 20%, got all the way up to $130,000. Now, they only give you half the up and none of the down, but in that period of time, averaged 6%, and there was no risk of loss whatsoever. So, folks, sometimes these accounts can be appropriate, but I just want to kind of illustrate how they work. So maybe if you have one of them, you can make a better decision regarding it. What are these expense ratios you find in mutual funds? Most importantly, how much risk can you take on? I want to talk to you about Social Security, the estate tax exemption, ladybird deeds. What are they? Modified adjusted gross income, tax bracket optimization, the sunken cost trap, 529 plans, the financial cycle, the Federal Reserve, income planning, tax planning, holistic planning, fees, bonds. Can I retire? Hi, in this segment, I want to talk to you about exchange-traded funds, or what we call ETFs. I got a call the other day. Somebody was looking to get into gold, and they wanted to know how they could own it physically. And I said, "Did you know that you could actually own it in an ETF?" And they're like, "I don't know what that is, Larry." And it just prompted me to, maybe take that situation and say, you know what, maybe this is something I haven't talked about on the show. What are they? First of all, understand that an exchange-traded fund is like a stock. It trades on stock exchanges, okay? It's a collection of securities, okay? So think of it as like a basket. And I can hold anything in that basket I want. It could be bonds. It could be certain sector stocks, like say I'm bullish on transportation. It can just hold transportation stocks. It can hold commodities like gold and silver. It can hold currencies, all right? Or you can have it be the inverse, which means it's short in certain sectors, so it's kind of betting on the opposite direction. It can hold cryptocurrencies. Now, I've had people talk about this, Larry, I don't know how to go out there and buy Bitcoin. Well, did you know that you could buy an ETF that tracks, Bitcoin as far as the value? So, very important to understand. Now, the first ETF came out in 1993. It was called SPDR, or SPDR. But the first actively traded ETF didn't come out till 2008. Now you say, what's an actively traded ETF? Well, remember, you got that basket of securities, there's no trading, right? It kind of closes and now you're just tracking it like an index, right? Well, an actively managed ETF is following a manager, maybe a mutual fund, maybe a certain manager's top picks, and it's mirroring that and keeping that in the ETF and following it accordingly. Now, the pros to an ETF is you can trade them during the day, unlike a mutual fund, which trades at the end of the day. So if you're in a certain sector and you're seeing momentum in the stock market and you want to get out of a certain ETF, you can trade it during the day, just like a stock. Now, typically, you want to use an ETF too because they can sometimes be cheaper than going out and buying the stocks themselves. Think about it. If I have to go out and buy Amazon, as high as that is, but if I can buy like a technology ETF that holds Amazon in it, can be much cheaper. Typically lower costs with an exchange traded fund because there's not a whole lot of trading. Now, a disadvantage with ETFs is if it's actively managed, it's going to come with some higher fees. Again, you can trade these during the day. That's going to be a good thing. Sometimes it can be a bad thing if you own just a single sector because you may not be diversified like you should be. People ask about dividends and interest. Yes, they actually grow in the ETFs as well. So you're not just tracking the value, you're also incurring the dividends and interest that's growing within it. Another advantage is no capital gain distributions like you see in a mutual fund, right? They're not passing those on to the people that own them, so it can be tax efficient. So hopefully that's been valuable to you, maybe give you a little bit more understanding with ETFs. If you want to learn more about those, give us a call.
Wow, two really interesting investment, different topics out there too. Pretty wildly different out there, the power of indexing and exchange traded fund, ETFs. That power of indexing typically is done through an annuity, which remember is an insurance product, so a little different and some different rules and stuff with that. But boy, what an interesting way for those out there that maybe want to minimize their risks to have some alternatives to those low interest rate CDs, maybe some low poor yields on bonds, or even with fixed annuity rates out there, not great right now either. Some alternatives really for that indexing out there that may play a role in your retirement portfolio.
Yeah, most definitely. And the other area that I know we talked about was the ETFs, or exchange traded funds, and it's a popular way a lot of money managers are investing now, or individuals just like you may be investing, where you may want to track a certain sector of the market. So I know Larry had referenced gold, silver, maybe Bitcoin, but others, simply as, hey, I want to track right now maybe the travel industry, as we've seen that's been knocked way down. Maybe there's upside potential. So you can find ETFs or exchange traded funds that would track that sector of the market. So again, a good way to maybe help in diversifying your portfolio to maybe find different sectors of the market that you may want to be invested in.
That's a great point, John. And if you're sitting out there and maybe you would like to know how these may play a role with your retirement portfolio, give us a call. The number on the screen will walk through maybe if some of these exchange traded fund or maybe some an indexing product that maybe makes sense for you to help build a little bit of safety in your retirement portfolio, or maybe producing income as well. The goal here is to help you plan to retire well. Coming up next to end the show here, Larry's going to dive into how Social Security is calculated. It's a pretty complex thing, so grab a pen and paper and stay with us here on Retiring Well.
Hi, my name is Larry Flynn. I'm a financial advisor, senior partner here at Centennial Wealth Advisory. Listen, with this coronavirus, it created unprecedented times. High unemployment, you got a lot of businesses not reopening. Whether there comes a treatment or a vaccine for this disease, we don't know. There's just a lot of questions, a lot of uncertainty. But your financial well-being is still very important. And if you're in retirement or near retirement, then getting some good, sound financial advice is going to be critical. So in these unprecedented times, we're understanding that safety is a concern, and so we're offering a couple options. If you're willing to talk by phone or want to do a virtual meeting, whether that be Zoom or something like that, we're offering that ability to do that. If you're somebody that does want to meet in person, we're trying to accommodate that as well. We're saying, we're not going to have any two clients meet at once. We're sanitizing it before and after you're here, and we're keeping the proper social distancing in place while we meet. So if these are a couple options you might want to pursue, we encourage you to just give us a call on the number that's on the screen, or visit our website at cen-wealth.com, and just basically you can set up a meeting there. Stay safe. If you have some financial concerns and need to address those, then certainly give us a call. Have you ever wondered how they calculate what your Social Security benefit is going to be? Now, folks, it's kind of a complicated formula, but basically they take all your working years. Okay, so they'll go back over all those years. If you get your Social Security benefit statement, you'll see that they've recorded that. All those years that you were putting into the Social Security system, they're looking at that amount of wages you had, all right? Now, what they do is they go back all those years and they take the top 35 years. Now think about it, when you were maybe 16 and you had your first job, you didn't make a whole lot, well, most likely if you've been working more than 35 years, that's not even going to count. Okay, so they take your top 35 years, okay, and then they index them to an amount based on whatever the average wage was when you were age 60. All right, so once you reach the age of 60, they look across the nation, they take what is the average wage, and then they go back to all those 35 years we were talking about, and they index them for inflation based on how long ago they were. So if it was 35 years ago, you can imagine they're going to give you greater weight for those wages in that year because of inflation, and they're going to match it up or index it to those average wages, like I said, at age 60. Now, they'll take all those years indexed again for inflation, and then they'll come up with an average. Okay? So let's just say they've taken all those years, they took your top 35, indexed them for inflation, and the average monthly amount that you earned ends up being $5,000 per month. $5,000 per month. So now they're going to take that number and they're going to try to determine what your benefit, your Social Security benefit, is going to be at full retirement age. So follow along with me here. Take that average monthly income of $5,000, okay? They're going to give you 90% of the first $926 of wages you have. 90%. So what's that going to come out to? That's going to come out to $833. Now think about it. For somebody that didn't make a whole lot in their earnings years, look what they're giving you, 90% at least. So at the very least, if somebody had, not a lot of income, but, had significant wages that were low, they're at least going to get that. Now, the amount that's above $926, but up to $5,583, they're going to give you 32% benefit of. All right? So again, going back to this example, that average monthly amount was $5,000. So what are they going to get? They're going to get 32% of $4,074, which is going to give them $1,303. Again, the difference between $926 and $5,000, $4,074, they're going to give you 32% of that. So now that's $1,303. Now, unfortunately, this person didn't make over $5,500, so they're not going to get any benefit of this next one, which is 15%. So if I'm a high-income individual, made a lot of money over the years, guess what? They're not giving you a whole lot more once you get over this amount. So what's that benefit total? I don't get anything here. Okay, so that benefit at full retirement age is going to be $2,136 per month. $2,136 per month. Now, remember, that's at full retirement age. Remember we talked about this in the early segment. What if I take it at age 62? Well, most likely it's going to be 25% less than this because I'm taking it early. What's that amount come out to? That's going to come out to $1,602. But if I wait to age 70, all right, remember at full retirement age, it's going to give me another 32%. All right, so if I get to age 70, now my benefit is going to be $2,819. Think about that. That's significant, and that's guaranteed for the rest of my life and has cost of living adjustments associated with it. If I don't have pension income, that's something that's very important. Folks, we can do an analysis for this for you. We can look at your benefits at full retirement age. We can look at your savings. We can look at, what kind of income you think you need, and we can develop a plan for you. So I encourage you, give us a call. If this is something you want us to work out for you, then give us a call.
Really glad Larry was able to dive into that for you, but one of the things, Art, that came to my mind through that process of Social Security is if you're maybe younger than age 65 and you're determining whether or not to draw Social Security, and you're potentially looking at health insurance benefits and how that additional income from Social Security may play a role. I was just sitting down with a couple recently, and we were running through those scenarios, and they had some other part-time income, some commercial real estate income and everything, and the way the numbers worked out, if they were to begin Social Security, then that would have eliminated them from the ability to maybe receive some health insurance subsidies. So again, another reason why we encourage you just to give us a call if you're at that stage where you're looking at whether or not to draw Social Security, what makes the most sense. There's maybe a number of different areas you haven't considered that would be worth looking into, such as another one like Roth conversion planning, right?
Absolutely, John. You've touched on some areas where a lot of people, Social Security decision, I think, becomes emotional, and they start thinking about, I'm going to get it when I can, or it's in the back of their mind for many years leading up to retirement. And you're right, healthcare planning, these Roth conversions. We've done lots of different shows on tax planning, but it's really interesting kind of on the back end how Social Security planning really makes a big difference on these other things. And when decisions are made with not looking at a holistic approach, it really can jeopardize some of the planning you can do, which potentially could be for long-term savings that would be leading up to your retirement portfolio. Who would have thought the day that you pick when to start Social Security would have an impact on what your health care would cost, or potentially what your tax rate would be 10 years down the road. So it's kind of an interesting piece as you continue to look at all the various aspects and the ways you can take it. Larry spent a lot of time talking about how it's calculated, and many of us, I think, just kind of maybe look at that statement or check on online and yep, it's going to be there, but it's so much more than that.
Yeah, for sure. And again, something Art said there was holistic planning, and that's something here at Centennial Wealth Advisory we like to focus on. It's not just about your investments. Your income comes into play, whether that's Social Security or pension. Taxes come into play, your estate planning, health insurance planning, all those different areas that are so key. And so we encourage you to give us a call for a no-cost, no-obligation visit. We'd love to sit down and chat and help you plan to retire well. Thanks again for tuning in.